also pleased to tell you that a large part of this growth, we've always had a good growth coming from healthcare business. But this is the first quarter that we are seeing that the rest of the business, the non-healthcare business, has actually grown faster than the healthcare business. So if you look at the healthcare business, it is grown by 13.5% for the first half of the year. And if you look at the non-healthcare part of the business, it's grown by 35.3% for the first half of this year compared to the last year. So this is, in fact, unique in this year that our growth momentum has come from the CES business as compared to what traditionally has always been driven by the healthcare business. In rupee terms, also the numbers are reasonably similar. You would say that the growth in the rest of the business is grown with specific numbers I'm going to tell you. It's grown from 11,844 million last half of the year, the first half of the last year, to 15,812 million in the first half of this year. That is a 33.5% growth on the CES business. Compared to that, the healthcare business last half of the year was 13,852 million. That has grown to 15,590 million. That growth constitutes about 12%. So you would see that the CES business has actually grown more than double of that of the healthcare business, giving us an overall growth number of 21.9% in rupee terms and 23.5% in dollar terms. Our digital business has also done well. We've signed up 14 engagements with new and existing clients. Client wins are impressive as well. 10 new logos across verticals for core BPM services and 7 for HRO and payroll processing in Q2. We continue to significantly work from home, and we haven't really gone back to offices. And as of now, I can only tell you that there are no concrete plans to bring people back to work because there is no requirement to do that. Even though vaccination rates have improved and I think in most countries the numbers are more under control, we still are being very, very cautious and taking each day at a time and not really looking at coming back to work and increasing risk for our workforce. Given the fact that it actually has not resulted in any dip in productivity, we see no reason why we should be concerned with that. Added factor is that while we use work from home as a principal mode for delivery, our operating expenses go down, and that's another strong reason why we believe that work from home is going to be a big chunk of our delivery going forward. Our headcount as on September 30th, 2021 is 46,698, an increase of 3,929 from the last quarter. Moving to the rest of the year outlook, I would say that with global travel improving, and in fact, both me and Tala are in North America. We came here as soon as North America opened up for travel. And with global travel improving and the sentiments for business also improving globally, that only bodes well for our industry. And we see demand coming back from some of the sectors which were under pressure, like travel and hospitality. We don't have much exposure to that. We have a few clients who are in that, so those clients will obviously prosper from the improvement in global travel. So going forward, the sales pipeline is healthy as well. I shared with you the respective growth numbers of CES and the healthcare business. I am encouraged to see that the CES business has continued to grow from strength to strength, and the growth momentum is going to continue in the second half of the year as well. While we speak to be able to handle this additional growth, we are actually setting up 2 new centers in Jamaica and Northern Ireland. This, you may believe, is actually contrary to what I've said, that most of our growth, most of our production will be on a work from home basis. So why are we building up centers then? The reason we are doing that is that our delivery footprint, work from home, far exceeds a situation where if you were to all come back to work, then the fees that we have will not be sufficient. So we have to build the right balance between how much is work from home and how much seats do you have as capacity if you need to come back to work. So you can't be in a situation where you don't invest in brick and mortar at all. And then as and when people declare that they can come back to work and people want to start going back to work, you don't have seats to be able to bring people back to work. So we don't want to be in that situation. That is the whole rationale behind why we are still investing in a few centers while we are divesting in some other centers which we believe we don't need for the future. So it's a balancing act that we're doing. Cash generation is very good. Pala is going to cover that in his section. We continue to reduce debt, and we have also increased the dividend this quarter, and that will be our continued focus to explore, continue to reward our shareholders. Before I hand over to Pala, I'm going to give you statements on the divestment of the healthcare services business. The divestment is on track. By and large, most of the regulatory approvals that are required in the 4 geographies that this deal is actually getting done are in the process of getting approved. We don't see any concerns out there. You will recall the transaction was based on an enterprise value of 1.2 billion, and it's subject to closing adjustment, shareholder and other regulatory approval. The divestment has been approved by the shareholders in the AGM held on 23rd of September 2021. And as I said, we are on track to get most of the approvals, and we see no concerns as to get to the final closure. With that, I'm going to hand this over to Pala for the details of the financials. So Pala, over to you.
Thank you, Partha. Before we start, I just want to check, is my audio clear? Okay.
Yes, sir.
Thank you. So, good evening, everyone. Welcome once again, and thank you for joining us on this call. I shall cover the financial section, and I shall move to slide 9. As Partha mentioned, it's been a quarter of very strong growth. Our revenues have grown by about 18.8% over the same period last year. And within this, both sectors have contributed to the growth. The healthcare business has grown 11.3% on year-on-year basis, while the non-healthcare business, coming primarily from UK, has grown at a phenomenal 28%, delivering overall growth on year-on-year basis of 18.8%. The EBITDA growth is 21.2%. We've had some benefits of exchange rates, so you would see an increase in the other income between quarter ending September 21 and quarter ending September 20, resulting PBT growth of about 88.6%. Coming to the PAT part, the growth on a year-on-year basis has been 68%, and about 16.6% is on a sequential basis. Just to recap, the tax provision for the quarter ending September 20, which is Q2 of last financial, is lower because we had some reversal on we created some deferred tax assets because of some internal restructuring, and hence the tax provision for Q2 of FY21 was low. Now it is at a more normative level, and the PAT growth after factoring the other components has grown by about 68% on a year-on-year basis. And on a sequential basis, the growth rate has been 16.6% for Q2 of FY22, and keeping in line with the performance of the company, the interim dividend, which stood at 7 rupees for the quarter ending June 21, has been increased to 10 rupees per share as second interim dividend for the quarter ending September 21. Moving to the next slide, again, a performance which is very strong. Growth in revenue terms, in rupee terms, has been 22%. Again, the growth on the CES side, the non-healthcare, has been faster than the growth on the healthcare side. Significant increase in EBITDA. It's grown by about 38%, and the margins have also increased by about 160 basis points to 14.6%. At the PBT level, profits are up by about 102%, and at the PAT level, profits are up by about 94%. So overall, a very strong performance in the second half of the year. In the first half of FY22 compared to the same period of FY21. As Partha mentioned, first half of FY21, we did have some costs relating to COVID, rolling out work from home. But as we mentioned, work from home has now become the norm, and these reflect the performance of our company for the first half of the year. Moving on to from an origination perspective, the revenue by vertical, healthcare is about 51%. We have done some tweaks because there are some parts of the business which were originally from the healthcare sector, but which would continue to be with SGS. These pertain to healthcare clients of our digital business or the HRO business. So there has been some reclass there. So healthcare now accounts for about 51%, little over 51%, and the rest of the business accounts for about 49% of the total revenue. From an origination perspective, revenues from US continue to be the largest at about 69.2%. The call-out item is really the UK business, which is 15.5%, and as this was roughly in the 7-8%, about a year ago. And as Partha mentioned earlier, this has grown by more than 100%, our UK originated business. So the share of UK also is showing up at a high 15.5%. And you can see now it's even higher than what our revenues from Canada. Next, moving on to the next slide. We have debt of about 3,445 million, which is about 47%. There has been a reduction between 31st March, 30th June, as well as coming up to 30th September. So the reduction in the first half of the year is 491 million or 49 crores. Within the existing debt, about 47% are term loans, and the balance are coming in the form of working capital. And as Partha mentioned, our endeavor would be to continue to reduce debt. Moving on to the next slide, slide 30. This talks about the increase in levels of cash as well as in terms of reduction of debt. Both have shown movements with reduction in debt and increase in cash, leaving SGS as of 30th September as a net cash company of 500.8 crores or 5,008 million rupees. Our cash flow continue to be strong. We had DSO days of 72 as of 31st of March 21. That dropped to 68 days as of June, and that has dropped further to 66 days as of September 21. In terms of capex, there has been some increase between Q1 and Q2, primarily because of what we mentioned. We are adding capacity in Jamaica and to some extent in UK, commensurate with the growth, and to make sure that if we need to come back to work, we have enough capacity. So as Partha mentioned, that there's no fixed timelines for that. From a free cash flow, EBITDA to free cash flow conversion, that continues to be strong. Though it has been a slight, there's been a dip between Q1 and Q2. That's primarily driven by higher capex rather than cash flow from the operations or working capital changes. The business ROC, which excludes the treasury income, with growth in performance that has continued to rise, and for the quarter on an annualized basis, stands at 25.8% as compared to 24.9% annualized on Q1 of FY22. We continue to take forward covers on a rolling 12 months, 24 months, 36 month basis. You will see there are three buckets. Obviously, the largest coverage is for FY22, and it comes down for 23 and 24. We have good rates compared to the spot rate, upwards of 80 for FY23 and upwards of 83 for FY24 and 25. Similar position in Philippines. We have forward covers of about 100 million for FY22 and about 27 million for FY23 with a rate of about 50.6. So summing up, from a balance sheet perspective, we continue to be having a very strong balance sheet. Net worth of 22,600 billion, book value of about 1,082 rupees per share. In the first half of the year, we have given 17 rupees per share as dividend, 7 rupees for the quarter one and 10 rupees for quarter two. And currently the stock price is trading somewhere in the P/E ratio of about 12.6. Traditionally, we have given you revenue profile for the HGS as a whole. In the subsequent slides, what we have going to do is cover the revenue profile of the business, showing the healthcare business separately and the rest of the business, which is the non-healthcare or CES business. This is obviously being done keeping in view the impending sale of the healthcare business. If you look at slide 18, on the healthcare side, the client concentration, the largest client accounts for about 39% of total revenues, and the top 5 goes up to 83.5%. For the rest of the business, non-healthcare or CES, the client concentration shares drop significantly. The healthcare, the top client dropping down to 12, and the top 10 customers dropping down from about 92 to 59. On an overall basis, on an aggregate basis, the top client is about 19.3, and the top 10 customers would account for 67.1%. From a channel mix perspective, the healthcare business is fairly split equally. About 51% is non-voice and 49.4% comprises voice and digital. Whereas on the non-healthcare, the CES business, the share of digital goes up to about 9.5%. The non-voice portion is smaller at about 10.6%, and about 80% is the overall is the voice business. On an overall basis, voice is about 71%, non-voice is about 22%, and we have about 6.7% coming from the digital business. If you go by revenue profile from our country of origination, healthcare is pretty much everything is from US, so it shows it's a single origination geography at 100% coming in from US. On the non-healthcare side, it's fairly diversified. US continues to be the largest, but down to about 38%. Europe, UK, that's the second largest, which is about 31%. And then Canada is the third largest at about 19%. India, which is primarily our HRO business, as well as we do some digital revenues originating from India, coming in at about 10%. But on an overall basis, US continues to be the largest at about 69%, with UK at 15.5% and Canada at about 9.4%. Moving on to the next slide, this shows the stock price movement for the last 12 months. And if you look at slide 21, HGS share price has gone up about 278% as compared to CNX IT of about 65% and Nifty 50 of about 40%. That's all I had in my section. We would like to open up for the Q&A. Thank you, ladies and gentlemen, once again for joining us on this call. We look forward to your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Nagraj Chandrasekhar from Laburnum Capital. Please go ahead.
Hi, thank you. So could you please update us on the timeline expected for the transaction to consummate, given you said everything is in place, and when it was originally announced a 90 to 120 day period, which implies a sort of November 10th to a December 10th date timeline is sort of implied?
So, Mr. Nagaraj, that kind of is still on track, I would say. Most of the regulatory approvals that we require to close this transaction across the four geographies, we're expecting to be met within the dates that you mentioned. After that, it's the logistics of getting the operational work done. So all of that is in track.
Understood. And just thank you for breaking out the business mix on a pro forma basis between the continuing and the divested businesses. Could you also give us some more color on the operating metrics on margin and working capital for the non-healthcare business, and how much operating cash you need to run this business, given I think at around a 3,000 crore run rate, we're already at 500 crores in net cash on the balance sheet?
Yeah, those are very good questions. So I'm going to deflect this question to Pala. We may not have those numbers ready for this presentation, but if you can provide that subsequently, you can do that. But Pala, probably you can give those numbers on a high level on this call.
Sure. Thank you. Good set of questions. Let me answer them to whatever extent I can. Let's go to the non-healthcare or the CES business, as we call it. That's about, as you have seen from the presentation, about 50%, close to 50% of the total revenue. A large chunk of this, as you would have seen from my earlier portion, the revenues are coming in from UK, which is again predominantly public sector. And yeah, unlike maybe in other geographies or what may be the perception, in UK we get paid as per contracted terms. So at the overall level, I don't see any significant difference between the DSO days for the healthcare business as well as for the CES or the non-healthcare business. Potentially, it is going to maybe even be better than what we have for the healthcare business. The other aspect is in terms, so that would address the issues of DSO days. Again, from a capex point of view, it is more driven by the location rather than by the nature of business, whether it's healthcare or CES. Right? So if I have to set up a seat in US or in Jamaica, it is agnostic whether the nature of business is going to be from healthcare or from CES. I hope that addresses your questions, Mr. Nanda.
And on margin?
Margins, as we said in our AGM, we are expecting margins to be around in the low double digits from a EBITDA margin perspective.
Understood. Got it. Thank you. Just one last question. You've seen a very large spike in hiring this quarter. So just curious, is this to replace anticipated attrition that are sort of serving out notice periods, or is this because you foresee a lot of growth on the non-healthcare side? And just wanted some more color on why we've seen such a strong bump up in numbers.
So we generally prepare for quarter 3 and quarter 4. So because of the seasonality in the healthcare business, the hiring ramps up in quarter 2 to meet the demand of quarter 3 and quarter 4. Also, you have seen that the UK business has actually grown significantly. So a lot of hiring is happening in UK as well.
Got it. Thank you.
Thank you very much. Participants, you may press star and 1 to ask a question. The next question is from the line of Siddharth Oberoi from Prudent Equity. Please go ahead.
Yeah, good evening. Yeah. So, I want to know, is there any warranty or claims or any penalty clause in this healthcare division sale where you don't meet the timeline, so there's some amount can be cut or something?
No. Nothing like that.
There's nothing like that. So the buyer cannot walk out of the deal right now, is that?
I think those concerns there are no concerns like that. As I told you in the previous question, we are on track for getting regulatory approvals. Regulatory approvals are required in India, Philippines, Jamaica, and US. And they are mostly expected in the next 2-3 weeks.
Okay, and any geography, or you mean all the 4 geographies are right now open, nothing has been concluded in any of them?
No, I wouldn't say that. Some approvals have come in respective geographies, whereas some approvals are required. It's not just one approval, there are multiple approvals required from, so the approval required from Competition Commission, there is approval required from export processing zones, all of that. And some approvals need to come to HGS and some approvals need to come from bearings. So, yeah, large chunk of the approvals have already come in. Some are still on track to close in the next 2 to 3 weeks.
Okay, so in the last con call, you had said that there is no one single check and there will be multiple, payments that will come from each geography.
That is correct.
Okay. All right. Okay. Also, I'd like to know, what is the exchange rate that will be for the calculation? It will be on the date of the agreement, a deal agreement, or whenever you receive the check.
Pala, you want to take the question?
Yeah. It's the rate applicable effectively on closing 1 or 2 days before closing.
Okay, that's on the closing date, right?
Yeah, essentially on the closing date.
All right. Also, have you put any thoughts on returning cash to the shareholders once the deal concludes, because we're just a month away?
Yeah, so this is actively being deliberated with the board. I have mentioned that very clearly in my statements as well, both to the media and in previous conference calls, that yes, a big consideration is to return value to the shareholders. That is the whole purpose why the deal was done. We wanted to do it in a tax-efficient manner. So all of these things are being deliberated with the board as we speak.
Okay. But is there any plan for delisting, etc., or you're not going on that road?
No, delisting has not been considered right now.
Okay. Also, in the presentation, you've given the breakup of the non-healthcare versus the healthcare. And, there are some of these verticals like technology, consumer retail, which have actually degrown. Technology degrew by 21%, consumer retail by 12%. However, there's a growth in the other verticals. So can you shed some light on, where exactly the portfolio of non-healthcare stands in terms of growth now?
So I don't know if you heard the conference call from the beginning. I shared with you that the growth on the non-healthcare part of the business for this quarter is more than double the growth for the healthcare business.
Okay, overall.
Yeah. On an overall basis,
yeah.
Let me just repeat the numbers for you. Hold on. Please bear with me. Yeah, so the healthcare business for this half year compared to last year grew by 13.5%, whereas the non-healthcare business, it grew by 35.3%. This is in dollar terms. So as I said, the non-healthcare business has actually grown more than double that of the healthcare business.
All right. That's all. Thank you so much.
Thank you. The next question is from the line of Nikhil Jain from Galaxy International. Please go ahead.
Yeah, good evening, sir. Thanks for the opportunity. Just a couple of points. So one was...
Your voice is not coming very clear.
Very muffled.
Yeah, I'm sorry. So I hope this is better.
Yes.
Yeah. So, sir, what I was just trying to understand was 2 points. So one was, let's say, we were looking at some acquisitions or some other ways to use the cash once it is available. So has there been any progress on that aspect? And would anything be finalized closer to, let's say, receiving the money or closing out the transaction? So that is point one.
So those are two independent things. Returning money to shareholders is an independent track, and funding growth both organically and inorganically is another track, right? So there is enough cash available to do justice to both. So mergers and acquisitions is something that we've done on an ongoing basis throughout our history. And as we speak, we evaluate multiple targets every quarter. So that's where we stand today.
Right, sir. But what I actually wanted to understand was that are we looking at some kind of a big acquisition given the money involved, or is it like kind of smaller acquisitions that we have been doing in the past and building up on those bases? So is there any thought, any progress, or any guidance on that?
So mostly our acquisitions that we're talking about are in the technology space. We've made it very clear that by 2025 we'll become a technology company. Right, so our efforts are therefore to grow on digital and our technology practice. So most of our acquisitions are therefore, the acquisition targets therefore are today focused on digital and technology acquisitions.
Right, and the size of the quantum we cannot still, let's say, we have not had any thoughts on.
No, I don't think I can tell you anything in specific because there isn't anything specific that we have right now. We evaluate this on an ongoing basis. So.
Okay, fair enough. And just my second question was that let's say with the money that is received, so and from our current cash position, so is there any intent of the management to let's say further increase the exposure to the group companies through ICDs or loans, or is it like a cap of let's say around 500 odd crores that we have?
So the current cap is 500 crores and we are well within that.
And we don't expect to increase it post the closure of the deals, right? So we'll have more cash available.
So I did not make any comments on what's going to happen once the deal closes. Right now, it's 500 crores, and we're going to remain within that cap.
Okay, fine. Thank you. I will come back in the queue.
Thank you. Participants, you may press star and one to ask a question. The next question is from the line of Manish Jain from Value First Digital Media. Please go ahead.
Yeah, good evening. My question is that from this deal value of $1.2 billion, is there any money which is going specifically to the promoters and not coming to the company as a no-compete deal or in any other form, money which will not come to company but will go to promoters?
No.
All money will come to the company.
Okay, thank you, sir. That was my question precisely. Thank you.
Thank you. The next question is from the line of Kapil Verma from SGS India. Please go ahead. Kapil Verma, may I request you to unmute your line from your side and go ahead with the question, please?
Hi. My question is that after signing of the BTA, what is the closing date? Is it 90 days or it's 60 days?
I think we've covered that multiple times on this Q&A today. At least I have answered these questions at least 2-3 times.
Okay. Second question is that we are thinking for acquisition of organic and inorganic things. So what is the percentage we are looking for the entire deal size for the acquisitions?
Again, I answered this question. I can't talk about a specific deal value. We are looking at acquisitions in the technology space. So right now, there isn't any specific target that we have in mind which says that this is the amount that we're going to spend. But no funds that are available to the company. The funds that are available to the company post the return of money to the shareholders are going to be used for organic and inorganic and debt reduction.
And like earlier acquisitions, we used to bleed money and losses year by year. So are there any plans that we are not requiring any loss-making entities?
So I think that is a very good question. I think we have had many criticisms about the two healthcare businesses that we acquired, which are loss-making. And you can find from the fact that we are able to sell that business as 1.2 billion that criticism was actually unfounded. Some of these acquisitions bring in capabilities but are not immediately cash, accretive or earnings accretive. You need to invest in those businesses to turn these things around, and then they start gaining value. The fact that these businesses, along with some of the acquisitions that we have done, which were loss-making, are actually being sold at this fantastic $1.2 billion valuation, tells you that just because there is some amount of cash burn to turn some of these acquisitions around to build on these capabilities, but steps in the right direction.
Understood. Thank you. Thank you so much.
Thank you very much. Participants, you may press star and one to ask a question. The next question is from the line of Jay Patel from ABK Consultants. Please go ahead.
Good evening, sir. So just wanted to check about your rationale for exiting the healthcare business. Was it because you found a good opportunity, a better opportunity, or was it because the healthcare business had reached its saturation?
I think that's an interesting question. We found that the business was not able to attract the value that it deserves from the Indian stock markets. It is a U.S. centered business. All its revenues as Pala shared is with the U.S. And therefore, people's ability to understand what this business is and what its inherent worth is, they're always finding the gap in understanding, and it is obviously my inability to sell the story to the Indian stock market. You saw the unlocking of the value that happened when an investor came in and understood what this business is all about. So we couldn't have continued with the valuation that we got with the business in the India stock exchanges, as opposed to its inherent worth to a possible investor. That we found that was not the best way to continue to keep the business in our portfolio.
Understood, sir. And next question, sir, on the same lines. Now with healthcare vertical gone, which vertical will actually replace when you see in terms of contribution to the revenue, overall revenue?
We have quite a few good verticals. We have got technology, media, telecom that is doing well. You've got the public sector which is doing well, and we got the digital businesses. So these three verticals will continue to be our engines for growth.
Understood, sir. Thank you, sir, for responses.
Yeah.
Thank you.
Welcome.
Next question is from the line of Manish Parekh, individual investor. Please go ahead.
Hello. Congratulations, sir, for the good set of numbers. Sir, I had this small question on the financial, on the balance sheet side. At the loans section, there is a advances of 552 crores as on September 21. And if you look at the related party, it is around 389 crores. Can you help me understand the residual amount to which party the amount is given?
Paula, you'll take that question.
Yeah. So it's an entity which is not a related party. So that's why it is showing up. That's why the difference you are talking about.
Okay, because I was referring to the credit rating report by CRISIL. They have mentioned that to the group and the group entities, overall the advances are to the tune of 553 crores. So I think there is a small discrepancy there in the rating report. Maybe they have missed out or...
Yeah. So, okay, thank you for pointing this out. I'll go and check that out. But clearly, if you look at our FY21 audited balance sheet, the numbers are clear. What is the loans, which is also what we have published for 31st March 21. The loans which are there to related parties.
Very true, sir. Very true. So I was a bit confused because in the credit rating report, they mentioned that as on June 30th, 553 crores are given to the exposure to the group entities. So,
Yeah. Thank you. We will take this up. Thank you for pointing this out.
Yeah. Thank you, sir. Thanks. Bye.
Thank you. The next question is from the line of Nikhil Jain from Galaxy International. Please go ahead.
Thank you once again for the opportunity. Just an additional question to Bala sir. Sir, this from the transaction consummate, so out of this $1.2 billion, how much is...
Your voice is coming.
Just try to do better. I hope it is better now.
Yes.
Yeah, go ahead.
Yeah. So what I was just asking was that out of the total transaction value of $1.2 billion, what would be the net amount that will come to the organization, let's say post the payment of taxes and other capital gains or other statutory levies? So any idea or any working on that which you can share?
So yeah. So I don't know if you've had a chance to look at the AGM notice what was published earlier. Essentially, the transaction has a business transfer component, or a slump sale as you'd call it in India, for India, Philippines, and Jamaica, whereas the transaction in US or US entity pertains to the sale of shares, right? So the tax rates for India and Philippines is roughly about 22%, given that the Philippines is a branch of the Indian entity. Since the US portion is through sale of shares of the U.S. entities by a Mauritius subsidiary. There, the tax rates will be pretty much close to zero, negligible. So at the overall level, we're working through, but we expect somewhere in the range of 10 to 12% going towards taxes.
Right. So that means that basically out of $1.2 billion, so the net inflow into the organization would be around $1.05 billion, plus minus let's say a couple of.
Yeah. Somewhere in that.
Okay. Right. And my second question was with respect to the comment that Partha have made actually about the value being recognized by the stock exchanges. So today also, if I look, and I have been a shareholder for some time, so the market cap of the company actually is less than half of even the cash that is coming into the organization actually, right? And leave aside the business that we will have, which will run very well over the next couple of years. So any thoughts, anything, what is the reason for this? Is still stock market not giving us the value that we deserve?
Yeah, so that is a matter of speculation, sir. I cannot comment. I simply may answer the question that why did we sell the business? The discrepancy between the price at which this business was being quoted in the Indian stock exchanges and the value that we were able to get from an investor who understands the US healthcare was so large that, just for the benefit of the shareholders, it did not make sense for us to continue to retain the business. That's why we did that. So that is, so hopefully people have seen that. Hopefully this will give people a better understanding, the investors in this company and the Indian investor, better understanding of what we do. The fact that so much value could be unlocked in that particular transaction. And hopefully, therefore, you will see the performance and the results and value the company differently. This is all I can say. The rest of it is a matter of speculation.
Okay, fair enough. Thank you, sir. Thanks.
Thank you. Participants, you may press star and one to ask a question. The next question is from the line of Raghav Agarwal from Star Securities. Please go ahead.
Hi, thank you for the opportunity. So, Mr. Partha, in the last call, you had hinted at your tuck-ins being around $25 million. So, and now that we're learning that these.
Sorry. What did you say? I didn't hear you properly. Can you please repeat what you said?
Yeah, sure. So, in the last con call, you hinted at your future tuck-ins to be around $25 million. So, based on that evidence, can you hear me? Am I audible?
Yes.
Yeah, so based on that, is it fair to estimate that even if we are aggressive in our acquisitions, that, you can still reward the shareholders with about $600-700 million out of the cash that's coming in?
Look, we will reward the shareholders pretty handsomely. I don't want to make a comment on the amount of that will be returned. Okay, the whole purpose of doing this exercise was to unlock value for the shareholders. And we are not going away from that requirement, from that objective. So I will not be able to give you specifics about quantum and all of that because this is currently being considered under deliberation with the board. We are looking at making it tax efficient as well. Not all forms of returning money to shareholders is equally tax efficient. There are multiple ways of doing that. Some are more tax efficient, some are not. So, this is still under deliberation. I won't be able to tell you specifically what amount is coming back at this level. This is very premature.
All right. Thank you for that. And one more thing, on the remainder portion of our business, what according to you is, a value? What should be our actual value if we don't consider how the Indian market is actually valuing our business?
Well, if you look at the healthcare business, it's $400 million. It's been valued at $1.2 billion. That is at 3 times revenues, right?
Yeah, correct.
So that gives you an indication. Rest of it, as a CEO, I will always feel that I'll undervalue. So, it's always a matter of perception. It's up to you to take a call. right? I can only show you profits. I can only show you cash flows. I can only show you strength of the balance sheets. And I can show you a track record of past 20 years of providing quarter-on-quarter growth and profitability and dividends. Right?
Yeah, that's something you've done phenomenally well at.
It's not me to comment on.
Okay. Thank you so much for your time.
Thank you.
Thank you. The next question is from the line of Manish Jain from Value First. Please go ahead.
Yeah, thanks for giving me a chance to ask a second question. There was just now a question that the value in the stock market is not even close to what the deal value will be, right? So market capitalization is lower. So there I want to make a comment. I'm in part of various discussions and forums in which shareholders of Hinduja Global give their comments and write things. I think one of the reasons for lower stock market price is that people have this fear in their mind that a good part of the money which will come in the company will go to promoter group entities. So if management makes a very clear commitment that more money will not go to group companies, I can assure you that share price will go up immediately by at least 25 to 30%. So this fear has to be removed from the mind of the shareholders if you really want to achieve your objective of giving good value to the shareholders. So this is my comment. If you can give some commitment, some answer, that would be great.
No, I thought we already answered that question. I clearly said no, that none of this money that is going to come in is going to go to the promoters. All the money is going to come to the company. I thought we already answered that question earlier in the call.
No, I'm saying as ICDs, as intercorporate loans. Money will not go to promoters, but not more loans will be given to group companies or promoter group companies.
There is a cap of 500 and we are within that 500 crores and we are within that cap. So we've not exceeded those caps.
So that will definitely show in the stock prices now, post this conference calls.
Yeah, I can't comment on that. I've already committed what the sale proceeds are going to go into. So that we have said nothing is going to the promoters. The entire money is coming in the company.
No, entire money is
over time,
to
right?
the company, but the money which is coming to the company now will not be given as fresh loans to the group companies. So that commitment will be very useful.
Okay, I think you should look at how we return money to the shareholders and then let's have a chat again.
Okay, thank you.
I don't believe that shareholders will have any reason to complain given the fact that the only reason that we did this deal was to unlock value for shareholders.
Thank you so much.
Thank you very much. Ladies and gentlemen, we'll take that.
We have run out of time now.
Ladies and gentlemen, we'll take that as the last question. I will now hand the conference over to Ms. Srinivas for closing comments.
Thank you, everyone. Thank you for your time and joining us on this Q2 earnings session, and also for a lot of feedback and the questions which were asked. Thank you for joining us on this call, and look forward to interacting with you when we do our Q3 earnings. Have a good day.
Thank you very much. On behalf of Hinduja Global Solutions Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.